So is this slide in equities the start of something bigger or a natural pullback after a big run? With me now is Stephanie Aliaga, JPMorgan Asset Management Global Market Strategist. Good to see you, Stephanie.
Good to see you, too.
Look, the market's feasted on some great earnings. We pretty much are through with that. Pretty much insatiable demand for semiconductors, AI hardware, all of that got into the market. What's your interpretation of exactly how we're seeing this pullback play out?
Yeah. Well, I think we have just had a ferocious rally this year, particularly around that hardware complex. I mean, as of yesterday's close, the semiconductor ETF had essentially doubled year to date in the first 5 months of this year. A lot of that was around earnings, but it's also telling us, look, at these levels, the bar is really high. And that means that there's going to be that sensitivity in markets, especially when you have some uncertainties really percolating in the second half of the year. What I don't, though, agree with is the reaction around this jobs report. As Rick Santoli was sharing, I think good news can be good news.
Yeah.
We saw a strengthening in the labor market, but we didn't see a firming in inflation. And I think that means that the Fed does not have to take issue with what we're seeing in the jobs market right now, because quits are lower than they have been 70% of the time on record, and there's no sign of wage inflation really firming here.
But I guess one could argue that it isn't the markets taking it as bad news. It was essentially doing heavy selling in the parts of the market that were going up a lot that had very little to do with the domestic economy or the job market, right? I mean, the AI trade has been independent of all those things. And now, consumer cyclicals, they outperformed by a lot today. Banks did not get pounded today. So in other words, it wasn't a reaction as if the economy was in a tougher spot. It's much more about the market dynamics and how we've been capitalizing.
No, absolutely. I think it's a short-term kind of digestion, right? And investors looking at their portfolios and making sure that, look, they have some stability there for what may come. And I think that's good news. That's healthy, And when it comes to all of the strength that we've seen in semis, it's natural for investors to start looking at other parts of this ecosystem here, because this AI wave is much bigger than just the hardware component, and we're seeing opportunities really across the economy.
Well, yeah, semis got to about 19% weighting in the S&P 500. AI, in a pretty direct way, is probably half the index, right? So that explains some of today's movement. What are some of those areas that you think have not been kind of fully reflective of the AI opportunity then?
Oh, absolutely. Well, I was just reminding myself of this great report from Eric Brynjolfsson in 2002. They found that in the internet era, for every $1 that firms spent on computer hardware, they spent $9 on complementary investments around retraining workers, around the software needed to embed the technology, reorienting workflows and designs. Now, it's not going to be the same 1-to-9 ratio when it comes to AI, but we're in the very early innings of all of that other spend that companies need to do. And you're hearing that from them this year, that they're expecting to increase the amount of AI spend per employee by 50% in the Atlanta Fed survey. And I don't know that all of that is really baked into market expectations just yet. The need for AI software, right? And also a lot of these other kind of complementary investments around AI.
It's hard to escape that all this is happening at a time when the amount of new stock that's going to be sold is growing beyond what we've ever seen before. So obviously SpaceX IPO, but then Alphabet secondary, all the rest of it. And whether it's causal or not, it's in the air that maybe this is a seller's market. How do you think about that, and how should investors react to it?
I think we should be buckled up for some volatility. Obviously, there's going to be some, high-profile, liquidity entering the market. However, I think when you take a step back and you remember that since 1990, the number of public market companies has essentially halved to 4,000. Meanwhile, there's been strong structural demand flowing into markets every day from people's 401k contributions, from massive passive inflows that are valuation agnostic for the most part, right? And all of that still puts pretty good structural support for markets. And we think that we can ultimately digest this new issuance this year. Of course, there's going to be some volatility along the way, but so long as there's a reason to invest, we think those inflows will be positive.
We haven't mentioned Iran. It's amazing all week. It seemed like it's been kind of on simmer, not really development that worth, kind of talking about as a market catalyst. But how does that fit in?
We're not out of the clear when it comes to this geopolitical situation, obviously. However, we do still think that we are on this de-escalatory path. The ball keeps getting moved a little farther and farther. But ultimately, look, the stock market is not the economy. And this economy is still quite insensitive, relatively speaking, to these energy price shocks. And you're seeing that resilience in a lot of the data that we've gotten lately.
And we're down again today.